How's it going, everyone? My name is Amos, and I have a question for you. If you're looking for a high dividend yield stock that pays a qualified dividend, then why are you not looking at the utility stocks? Why? And I get it. I hear you. The utility sector, no, it's not AI. No, it's not a sexy business product or a service that they're doing. However, it is essential for everybody. Everybody's got to pay their electricity bill if you want your Wi-Fi to be running in your house, if you want to be able to charge your phone at home. The list goes on and on. The electricity bill is something that people are not going to just not do. I think there's a lot in our lives that we can live without, but electricity is something that, especially as Americans, no, we need it. Because in the summertime, when it's super hot and humid, your butthole is sweaty as soon as you step out your door in South Carolina, you're going to be grateful to have AC in your house. And if you want that AC to be up and running, you got to pay your utility bill. But to break it down into more of a science, number one, for the most part, utilities are regulated, meaning their profits and how much they can charge is predetermined by the local government and authorities. As such, they're allowed to operate as a monopoly in their region or neighborhood. When you move to a new zip code, you don't have 10 or 20 utility companies to pick and choose from. Usually there's only one company that you can do business with, unless you do Tesla, of course, and you install solar panels all over your roof. And reason number two, because they're regulated monopolies, the cash flow tends to be consistent and predictable. I think going forward, the utilities will be good in states that are thriving because more homes and properties are going to be built in their service territory. And lastly, utility stocks tend to be a proxy for bonds because they offer dividends that rarely ever get cut unless that utility company in question is a hot mess. And yes, there's two that we're going to be talking about that will be a ugly, disgusting, smelly utility company. All that to say, it's a monopolistic business model that prints cash during the good times and during recessions. Dude, sign me up. And that's a really good question. What's the catalyst for the boring utility stocks going forward? Well, for one, as a society, we're moving towards electrification, meaning we're relying less on carbon sources of power. Natural gas, coal, dude, see you later. For example, charging EVs at home or at a station, and since the pandemic, there's more and more people that are working from home, like me, and more of our appliances and gadgets are using rechargeable batteries that need to be plugged in order to be juiced up, rather than relying on gas. And of course, with the weather and climate and temperatures going up and up, I think AC is a thank the good Lord that AC is a thing. So if you don't get it by now, what I'm saying is that the electricity demand is only going to get bigger as we move forward. But more importantly, as AI demand grows from all different sectors and companies and businesses, so will their data centers that will ultimately be powered by the utilities. Because solar panels that are installed on top of those warehouses, they're not 100% foolproof, with the weather being super unpredictable, and then during the winter months, it might be cloudy and you're not gonna have any juice. So the utilities will be necessary. Even though the power will be capped at a fixed price point, the data centers will be using more volume. So they're gonna be buying up more power. And Goldman Sachs research forecasts that global power demand from data centers will increase by 50% by 2027 from now, and as much as 165% by the end of the decade. So you might disagree with me, but I think that the boring utility stocks, yeah, they have a pretty good future. And the next thing that I want to talk about is the net domestic migration. One thing to keep in mind is that the population change in the US is not happening with even distribution across the states. Some states are more popular than others. So when we look at the net migration numbers in the US, which is people moving into the state minus people that are leaving, what's net positive, the losers, as you can see by this graph on your screen right now, the darker blue, California and New York, which are two very heavy tax burden states, but also Alaska, which is kind of strange. And the biggest winners, as depicted by the red, are South Carolina with a 12.5% population change in the green. Also Idaho at 8.3%, Delaware at 7.8%, Nevada, Georgia, Tennessee, and North Carolina are also growing their population more so than they are losing. So In this video, we're going to evaluate and grade 21 different power electric utility companies. This is part one in a two-part series. And by the way, if you want to know about the water utility stocks, did you know that I already made a video about that one? So watch that one after this one. I promise you it'll be worth your time. So without further ado, let's go ahead and get into it with utility stock number one. And that's going to be NRG Energy, ticker symbol NRG. They're a fully deregulated merchant power generator, and they also do retail energy. And they operate mostly in Texas, but they do have a footprint in 24 different states. And if you're not tracking, a merchant generator is a company that sells electricity wholesale. So the big difference that you have to know is a regulated utility is going to be more stable, is slow and steady because their prices are fixed. You can't charge more than a certain amount, as established by the local authorities. Whereas a deregulated utility company like NRG, they can charge whatever the heck they want at the market rate. So there's more upside, but there's also a bigger risk to that. Because with a regulated utility company, you have a customer base in your territory that will consistently and reliably pay their bills on time every month. Plus or minus like 0.01% of the population that might not pay their bills. However, with the unregulated side, your customer base, it fluctuates. There's people that are gonna be buying power in one quarter and then no power the next quarter. So it's really unpredictable. So when the highs are high, all you have to track is that for the unregulated utility companies, the highs are really high. But when the lows are low, it's like a cyclical death sentence. However, it usually pans out with the unregulated utility companies having a bigger CAGR. So when it comes to NRG, what are we working with? Their stock price right now, as of the market close on Friday, $151.80. Is their revenue, their top line growing year over year? Absolutely. And then their earnings per share, the bottom line, their profits per share outstanding, $6.20. The dividend payout is $1.70. So when you think about the payout ratio, 27% of their bottom line is utilized to fund the dividends. Absolutely sustainable. And that's why some of you might see this 1.2% dividend yield and dismiss them. But what I'm looking at is the growth rate of 8%, meaning this number grows at a rate of 8% year over year, and it's really healthy. Because riddle me this, what good is it to have a dividend that is juicy, but it's not sustainable? Meaning the leadership team and the executive board, they're going to cut it in the near future. It makes no sense, right? Wouldn't you rather have a dividend that is more reliable, healthy, sustainable, and has the ability to grow at 8% year over year? And then when it comes to their return on capital employed, we're talking about a 16.2%. And I'll explain more about this metric when it comes to the next company. And then of course, I don't know about you, but performance absolutely matters. It's not just something that your ex-wife used to say. So when it comes to evaluating their total return, their share price appreciation, plus their dividends paid out, when you marry the two, what do you get year over year, broken down on an annualized basis? The CAGR, the compound annual growth rate. Sorry, we're talking about a 12.6% year over year, past 20 years. Now in the exact same time period, the S&P 500, which is what we investors refer to as the market, the benchmark that we're all trying to beat, was 10.5%, as you can see right there. So 12.6%. So when it comes to giving them a grade, this is absolutely an S, not an S&P 500, an S. And I wanted to start the video off with an outlier to prove my point that utilities can be dividend compounders with cheese. The next company that we're gonna be talking about is gonna be regulated, and it's gonna be more of your normal utility. 95% of the companies that we're talking about are regulated, just so you have a heads up. And that next company is Exelon Corporation, ticker symbol EXC. They operate in the mid-Atlantic coast region, including Washington, D.C. and New Jersey. And their market price right now is $43. Their revenue is growing year over year. Their dividend yield, quite good. For me, the minimum standard to have a decent dividend yield is at least 3%. And to see 3.7%, Not bad. And is it sustainable? It's sustainable. And are they growing it? They're growing it at a rate of 5.1%. What do you mean growing? This number right here, $1.60, is growing at a rate of 5.1% year over year. And when it comes to their return on capital employed, we're talking about a 4.6%. And the ROCE basically tells you how efficiently the company is turning invested capital, including CapEx, into operating profits. Now, when it comes to the utilities, this is really important because they operate with a crap ton of debt, leverage, loans. It's just the name of the game. It's nothing to be scared about. So there's a lot of debt and there's a lot of share dilution. Almost every single year, they issue more shares to raise more capital. So in other ways that you want to think about the ROCE is for every $1 that they spend building out power plants, expanding grids, installing solar, wind, whatever, how much is this utility company earning from the operations? Now, because Exelon is regulated, their ROCE is going to be modest. Legally, they're not allowed to go above the rate that the local authorities establish for them. For the most part, it tends to be a number between like 6, 7, or even like 8%. So to have it be at 4.6% might seem low in comparison to NRG, but remember, they're unregulated. They can take this number as high as they want. Whereas for Exelon, they can't go above the certain threshold. So 4.6%, believe it or not, is not bad. You want to see a number closer to at least 5% for regulated utility, but at 4.6%, you can't complain. I think the red flag is waving once it goes below 4%. And to round out my evaluation for Exelon Corporation, their CAGR is 5.9%. So I think everything else was pretty good leading up to their performance. So all in all, I think Exelon is the definition, and that's why I wanted to give you more of a standard look at a regulated utility company for the second example. It's a very average utility. It's neither really excellent and superior, but it's not ugly either. It's just straight in the middle. It's not bad or good. If you invest into them, I can understand why you would do so. But I'm telling you right now, there's 19 more utility stocks that we're going to cover, 21 in total, and there's gonna be some dividend compounders with cheese that makes NRG pale in comparison. So you gotta keep watching, okay? So this one, I'm gonna go ahead and say a C. And the next regulated utility is going to be First Energy Corporation, ticker symbol FE. And they operate in the Midwest and in the East Coast. Now let's take a look at their numbers. Their top line is growing year over year. Their dividend yield is about 4.4%. Is it sustainable though, friends and family? A 95%. For me, I think that goes beyond my comfort level. Now, when it comes to the utilities, I think the payout ratio is gonna be a little higher than usual because the utility sector as a whole is very mature, established, and they have like 100 or 200 years of company history. These are not startups that we are talking about, meaning their earnings per share growth, you're not gonna see numbers like 20% year over year. Rather, you're lucky to see something like the rate of their dividend growth at 5%. So it's still humble, it's good, but it's nothing to, brag about on your Twitter account or on your MySpace. But I digress. So what I'm saying is the payout ratio is usually gonna be around like a 60 to around a 80%. I feel like that's a very healthy zone. And then the yellow flag, I would argue 81 to 85%. 85%, I still think it's sustainable. As long as they improve their net income per share in the future, I think that dividend is going to be safe and steady. But when we start going into the territory of 90%, and in this case for First Energy Corporation, 95% of your bottom line is used to pay out the dividends, you only have 5% of your net income and your profits to work with to reinvest into the business, to do this and to do that. That means they're gonna have to take out more loans in order to maintain and to improve and upgrade their equipment, because with the utility sector, you can't just build a power plant and call it a day. Every single quarter, every single week, every 24 hours, there's maintenance, there's repairs, there's upgrades. There's something always happening on a micro level, but on the macro level, there's a lot of CapEx, meaning they want to open up a new power plant. They want to open up more wind solar fans. They don't just want to have a portfolio of 10. They want 11. They want 12. So to see 95% of their profits going towards the dividend, for me, I don't like. And to make matters worse, when we look at their CAGR, their performance in the stock market at 3.4%, Friends and family, I don't care how you spin it or manipulate it. If you are invested into them, I am sorry. If you're triggered and you're pissed off, I get it. I don't like when people make fun of my investments either. Okay, I get triggered, I get offended, I want my safe space, so I hear you. But for my money to only grow my rate of return, my return on investment, 3.4% year over year for the past 20 years, guys, it's hideous. It's ugly. I'm telling you right now, it's like going to Thailand, having one too many Singha beers, and then making out with a ladyboy, and your best pals are next to you saying, dude, don't do it, Mark. What are you doing? Don't do it. And you're like, dude, she's hot. You're going to regret it in the morning. So is it fair for me to label First Energy Corporation as a D? It's below average. I don't think this is a company that any of us should be going towards or should be on our watch list. Now, the next regulated utility company is going to be NextEra Energy, and they're pound for pound the biggest utility company in the US by their market cap. And they're mostly in Florida, but they also do renewable energy from the wind and sun in 49 different states. Yes, you heard that right. 49 different states. However, what I do want to call out is, as you can see right there, is their top line, their revenue growing year over year? Friends and family, it is not. And as a matter of fact, upon further inspection, their numbers across the board have been declining since 2023. That's not good. However, historically, NextEra Energy has been a dividend compounder with cheese. Instead of operating with like the old historic model of doing utilities like natural gas and coal, from the get-go, they've always been about the renewable energy mission. As such, their business model is predicated upon even more at an aggressive rate of doing CapEx, if that makes sense. And if you've been paying attention, the interest rate right now is bonkers. It's really high. So if you pull up their numbers in 2020, 2021, they were crushing it. Why? Because to take out loans and in order to finance these projects, it was like a 0.25%. It was negligible. The loans were super easy. But right now, for them, the cost to do business, to be a renewable energy player, it's kind of expensive. And that's why they're struggle boating. And even though they're struggle boating, a questionable call from the leadership is that they're growing their dividend at a rate of 10%. Now on surface level, you might be like, dude, that's amazing. But I feel like they should pause and pump the brakes, sip some water, pull up the pants, put your training bra on and think about it, because the payout ratio is 85%. What I'm trying to say to you is their net income per share is $2.67. They're paying out $2.27 in dividends. Can they keep growing their dividend at a rate of 10% year over year? I just feel like it's not a wise business decision. It's not sound. So I don't agree with their leadership. I think it's better to just grow it at a very modest rate of like 3% and then use that other 7% to invest back into the business instead of taking out more loans, but instead using your profits in order to help finance the next CapEx project. You see my train of thought? But up until their numbers started to decline in 2023, they did in fact crush the market really hard. So consequently, a lot of their gains happened like 5, 6, 7, 8 years ago, but in the past like 2.5 years, it's been miserable. But even then, their CAGR is still 13.5%. Now, if they weren't going on such a steep decline quarter after quarter, week after week for the past like 2 years, I feel like that CAGR would be a lot higher. So all of the factors taken into account, knowing their history that they used to be a really good business model operation and crushing it, but for the past 2.5 years, they're struggling because from the get-go, they are a renewable energy utility company. Understanding all of the variables and factors, I would still label NextEra as a B+. I think they're the biggest market cap for a good reason. Market cap is another way of saying they're very popular. How do I know this? Because there's more money pumping into them, inflating the price of their market share. And another element before I forget about NextEra is because they're so advanced in their renewable energy operation, some of the other utility companies that we're talking about here today, they actually pay and consult with NextEra so that they can copy and transition from using the old carbon methodology to using the more renewable green energy that most states are now trying to slowly pass and mandate. So they they do also have a revenue model from that, helping out the other utility players. Now, before we go on to company number 5, between you and me, I've been prepping for my first marathon. It's something that I've been saying I'm going to do every single year, and then I make up the worst excuses of, oh, I can't do it because of this. I'm too busy. I don't feel like it. I don't want to get in shape. The list goes on and on. I have my first kid coming this year, and I was like, you know what? I'm going to knock out a marathon before she is born. I'm going to do it. And so as I am prepping, I'm running almost every other day because you do need some rest days, right? So your body can recover. Otherwise, you're going to be slower and you're going to be running on empty. And what's really weird about my training is, for the past 2 running sessions, you would think that I would listen to my usual old school hip hop and rap or heavy metal music or house music, techno and trance. No, I deviated away from that. And I've been listening to, dude, don't laugh. I'm serious, don't laugh. I've been listening to mariachi music with like the traditional Mexican bands. And number 2, Native American, the people's powwow chants. So I'm like, dude, I don't even, but it fires me up, dude. It gets me wired. All that to say, if you know any good mariachi songs or music, please put me on. Please do give me some recommendations. As for the powwows, I don't really discriminate. I like every single tribe and nation. I like the Cherokee, I like the Iroquois, I like the Comanches, the Navajo, and the list goes on and on. I'm addicted to it. Anyways, back to the video, let's get on with it. Company number 5 is gonna be WEC Energy Group, and it's a regulated utility company that operates in the Midwest in states like Wisconsin, Illinois, Michigan, and Minnesota. Currently trading for about $107. Revenue is growing year over year. Their earnings per share, their bottom line per share is $5. Annual dividend payout is $3.57. Dividend yield, good, 3.3%. Growth rate, also very good. Payout ratio tells us it's absolutely healthy and in line with what it should be. The return on capital employed looks pretty darn phenomenal, 5.2%. Their performance is also good. So friends and family, what I'm seeing here is that their dividend yield is good, but their performance is also matching that energy, and their business, their revenue, their top line is ultimately growing. So out of the entire 21 utility stocks, we have our first S in the regulated component, and then NRG is in the unregulated side of the house. And the next utility is going to be Entergy Corporation. Dude, usually I'm a fan of like play on words and stuff like that, but that one trips me up. Not a fan. But anyways, it's clever. Ticker symbol ETR, and they operate in the southern states like Mississippi and Louisiana. Between you and me, I'm going to tell you right now, I'm not too bullish about the southern states, because if you think about where the big money is going and where the real estate developments are happening and where the tech companies are situated and located, talking about like Salt Lake City, we're talking about the Bay Area in California, Seattle, New York City, Northern Virginia, ain't nobody trying to open up shop in freaking Arkansas or Kentucky or Mississippi. I don't want to throw shade on you if you live in those states, but it's just the reality of business. Why is my hand so big and black? What the heck? But anyways, $86.40. Is their top line growing year over year? No, it's not, and I'm not surprised by that. I'm not too bullish on the southern states. I'm sorry if I'm triggering and offending you. If you're a fan of the Confederacy, dude, get with the times. You lost the war. But jokes aside, their numbers look pretty standard. Dividend yield, not bad, just shy of 3%. Growth rate is 6%, healthy. Performance, also not bad. Remember, the S&P 500 was 10.5%. 8.4%, not bad at all. Now, because Entergy's revenue is not growing year over year, and they operate in a region of the US that I'm not too particularly excited about, I think we're gonna have to give them a C. It's not the best thing in the world, but it's far from being the worst either. Now, if you are in fact invested into Entergy, let me know. What am I missing? What's the investing thesis behind them? Because to me, they're just plain vanilla. Like getting a pair of jeans from Costco once you turn 35. It's like a male thing that we all go through. We just get our clothes from Costco. The next utility company is going to be the Public Service Enterprise Group Incorporated, ticker symbol PEG, P-E-G. I'm just going to refer to them as PEG. The real name is too long-winded. It's a regulated utility that operates in the Mid-Atlantic region, such as Long Island and New Jersey. $84 a share, the revenue is growing. Earnings per share, this checks out. Payout ratio is pretty safe. Dividend yield is good. Growth rate. So the one thing that you're seeing, commonality across the board so far, whether they're beautiful or ugly or handsome, is that they're growing their dividend at a very impressive rate. Wouldn't you say? That's why I think for a dividend investor, dividend growth investors alike, I feel like the utility companies are slept on. Just all I'm trying to say, okay? And their return on capital employed is 5.1%, total return is 9%, and I do have good feelings about New York and that Mid-Atlantic region. So ultimately, across the board, I thought everything was above average. I liked what I saw. I'm going back and forth right now, like a B and an A. Maybe we can meet in the middle and say B+. We'll say B+. It's above average. I like it. PEG, not bad. Now, the next utility company is going to be the AES Corporation, ticker symbol AES. And unlike the other utility stocks covered so far, AES has a global exposure and a mix of regulated and merchant assets. However, a big chunk and a bulk of their revenue is made from the unregulated side of the business with their power plants. They actually operate in South America as well. Now, their past history is kind of boring and very underwhelming. However, for the past 3 to 4 years, their business model has pivoted and has transitioned to what's trending right now, the AI movement. Because the AES Corporation, they sell energy and backup power to the data center power-hungry companies such as AWS, Microsoft, and Google. And because of that investing thesis, not too long ago, I actually did buy into them for $10 a share. And then once they had their recovery rebound to $13 a share, I sold out of them quickly because I do not see them as a long-term investment. Even though their business model is catered towards the AI data centers, I'm not in love with the way they're doing it. And there's other players that have a more established relationship that seems to be a little more stable and reliable. Case in point, their revenue, is it growing year over year? It's not. However, their dividend yield, quite juicy, and the payout ratio, it says it's safe. However, what I do want to call out is your money would have grown at a rate of 1% year over year. Dude, that's almost offensive. That's like someone saying something racist to me in my comments section. That triggers me. A 1% CAGR? Dude, that's disgusting. So consequently, if you're thinking about investing into them for that data center wave, there's better options out there and on this list. AES is just not it. So ultimately for me, I think they're a D-, almost in that F territory, but their saving grace is their very high and juicy dividend profile that seems to be sustainable. That's what's saving them. And the next regulated utility is going to be the PPL Corporation, ticker symbol PPL, and they operate in 3 states exclusively: Pennsylvania, Kentucky, and Rhode Island. And fun fact, I actually researched this company 5 years ago, and they used to also have a UK arm of the business that they sold off. They're like, dude, we don't want to do any more business in England across the pond. So they only operate in those 3 states. And right now, they're $36 a share. Their dividend growth rate is 6.5%. The payout ratio is in that yellow flag territory, but it does seem to be stable and sustainable. Their CAGR is 5.9%. We'll just go ahead and label them as average. I think PPL is a C. And that just about rounds it out for part 1 in this 2-part series. Your biggest takeaway should be that regulated utility stocks are a pretty good replacement for fixed income in your portfolios in lieu of bonds. I'm not a financial advisor, that's just my personal opinion. And before I sign out of here, did you know that the insurance stocks are some of the best pound for pound performers in the stock market? Because I made a very similar video to what you're seeing right here, where I break down and analyze the best and the worst insurance stocks, and that video is exclusively available on Patreon. But anyways, if you're not interested in the insurance industry, please subscribe so that you can stay informed of when part 2 of this video drops and gets uploaded. I'll see you guys next time. Good luck in the stock market, stay safe, I love you, see ya.